Hello, my friends. Brett Pattison with Iron Gate Global Advisors coming at you from the financial capital of the West. That, my friends, is Salt Lake City, Utah. I'm excited to be able to share with you two important historically based reasons why you should be optimistic about the market. So thanks for taking a few minutes of your time today to listen in. Let's first put the recap and the finishing touches on what was a really good month in October. A really good month because, as you can see here, the leaves are changing. There's a World Series taking place. College football is in its prime right now. You could go on and on, right? The skiers, if you're a skier out there, you're polishing your skis, you're getting them ready. But most importantly, the month of October was a fantastic month for the stock market. And I'll show with you what I mean by that as we look at a few returns. But before we do, back in September, I used this exact slide as we were in the midst of some pretty good volatility. And if you recall, we talked about what had happened in 2011 as far as a stock market correction. All right, the stock market pulled back about 16% in 2011. And we thought and we discussed on that video that, maybe this is what this is what was happening, in 2015, although we're never quite sure. And let's fast forward to what occurred in 2015. Here's a big chart, far left, 2011, where we saw that pull back about 16% again. Far right-hand side, you can see what occurred now, right, in 2015. And that was about a 12% pullback, which certainly is a correction, okay? And let's even look at these side by side. 2011, again, down 16%, give or take, depending upon the lows that you align yourself to. But certainly a lot of volatility. 2015, not as much volatility. And I am more than happy to admit when I'm wrong, and I was wrong about 2015 in this way. I thought there would be more volatility than there was. I was expecting a little bit more drastic pullback, maybe a retest of the lows, which there really wasn't. It was down really in the course of a week and then boom, back up. Now we did what our processes tell us to, and I urge everybody to have a process for investing and follow it, and preserve capital because you never know what's going to happen. But when everything points to being bullish, you have to align yourself to that. And so not the volatility I was expecting and actually hoping for from an option trader's perspective, but that's the correction. A correction and no more, right? At least now, no more. Let's take a look at the returns for October. Here's the returns, which again were phenomenal. The U.S. had the best month at up 9+%. The developed non-U.S. everything's positive, right? Even emerging markets were positive. The MSCI All World Index 8.27% return. The U.S. led the way, and as we look at 2015 returns, they're okay. They're not great. They're okay, with the U.S. taking the lead still at 1.77%. It is leading, and I thought the rest of the globe was going to take over the U.S. this year. So, as of right now, they're slightly ahead. We'll see how the year closes out, which again, you should be optimistic about. Let's take a quick look at the sectors. I'm not going to spend too much time here. I just want to highlight a few things. These were October returns. Energy, great month, right? Utilities, no, not really. Kind of been a dumpster fire all year, utilities has. Then you look at the year-to-date returns, and you've had consumer discretionary has been on fire, and according to, we'll talk more about it, but should remain on fire. And then you've had energy, which, much like utilities, has been a dumpster fire. But all in all, a great October, great returns, and really an opportunity for us to buy good stocks at a good discount as well, for our clients. And now we're positioning portfolios, and our clients will begin to see through the rest of this market commentary exactly why we're making the changes we are. But I want to preface these reasons to be optimistic by quoting one of my favorite investors of all time. And he said this. He said, the 4 most dangerous words in investing, this time is different, right? Sir John Templeton said that, and I love that because you hear all sorts of crap out there in the media about how the market's going to implode and all these things are going to happen, and buy gold and get some rice and some ammo and some helmets and go and find yourself, dig a cave. And no. That's why that saying and many, many other reasons are why we study the past to help determine what may happen in the future, right? What may happen in the future. Because when he says this time is different, or dangerous words, they are, because something's interesting about the human mind, right? This human psychology, it doesn't change. It's the same. As much as everyone wants to believe, people act differently, they don't. And so that's why studying history is so important. And so what may happen in the future, and this is the reasons to be optimistic right here. All right, a couple things. We know there's 2 kind of 6-month portions of every year as far as stock market returns go. We know November through April, the S&P averages about 7%, while May through October, it averages about 0.8%. Okay. So look at those returns. You can tell me which 6 months is the better 6 months. I mean, it's quite obvious, right? The best months, in fact, are November, December, and April. 1.5% average return, S&P-wise, in November. December, great month. January as well is a great month. Of course, April's a little better than January. But November, December, January, the best 3 months, historically speaking, of every year. The worst months being June, August, September. So if you look at that for a second and you understand that, okay, historically speaking, November, December, January, and November, December, April, and November through April are the best months. Now, it's not a guarantee that those returns are going to come. You have anywhere, on a given month, you have anywhere from a 65 to a 78% probability that those returns happen, all right, depending upon the month, depending upon the sector. But the point there is it's a high probability, and that's what we align ourselves to, is the high probability that something's going to occur, all right? So be optimistic. We're heading into a great time of the year, November, December, January, and really November through April. Let's take a look at some historical sector returns. Again, we study the past to help determine what may happen in the future. We're going to tear this apart. November through April, there's 2 sectors that I'll point out. There's consumer discretionary and the industrial sector, each with about a 70 to 80% probability that they return better returns than the S&P, historically speaking, right? We study the past to help determine what may happen in the future, and if you got a 75% probability that a sector is going to outperform the market, which averages about 7%, there's a strong reason or argument to make that trade, right? To put capital to work. And that's what we're talking about. So it's consumer discretionary and industrials. And note to our clients, you can see what's happening if you look at your portfolios. Those that aren't clients, I can't take that any further, all right? This is not a recommendation, by the way, to do anything to your portfolio. Consult a professional beforehand, disclosures, right? And we know that May through October, there's 2 sectors that perform very well, typically healthcare and consumer staples. All right, so if we're focusing on November through April, certainly a reason to be optimistic. The last reason to be optimistic, I'm going to take us to interest rates for a second. And this slide is directly from our interest rate video, which if you haven't watched, you need to, about interest rates and what happens to the market when interest rates start rising. And Yellen, just this week, right, and the FOMC pointed to probably December, Yellen said in an address to a university, they're looking this year, when there's only one more meeting this year, and that's in December. So we know that we hate, you will know that we, if you've listened to us in the past, that we hate the fixed income markets. It's something we don't like, and interest rates are one reason why. Overvaluation would be another. But here's the interesting thing, and there's a lot of data there, right? And I'm going to make this very simple. On the far left where it says date of first rate hike, that's when rates were very low. They were historically low, or not historically low, but very, very low. And then the Fed started to raise rates. Okay? And so you have a couple columns here. You have the prior 12-month, which is the next column on the right. We're going to ignore that. You have these two other columns, which are what are the next 12-month percent returns for the market, and what are the next 24% or 24-month percent returns. And historically speaking, when the Fed starts raising rates for the next 12 months, on average, about 7%. All right, 7% return the next 12 months. The next 24 months is even better. It's about a 19% return on average. That's not a guarantee, but that's, again, why we study history. Raising rates is not a bad thing for equities. For fixed income, it is a bad thing. For equities, it's not. So there's a couple reasons to be optimistic here. It's a great time of year, historically the best time of year, and you've got interest rates about ready to move higher, which is a positive thing for the equity market. I hope that sheds some light on where we are right now in the markets. Turn off the TV if it's causing confusion. Follow the process that you have in place. Certainly give us a call if there's anything that we can help you with. Here is my contact information, Brett Pattison. You got my email there, brett@igga.com, phone, Twitter, LinkedIn. You can like us on Facebook. Thank you for taking time out of what I know is a busy schedule for you to understand where we are and where we may be heading in the market. We'll talk to you next month. Thanks.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.